Welcome to the Explainer. We're going to pry open the books of a financial titan right at its most vulnerable moment. I'm talking about the day it had to spill all its secrets just to ask the public for money. And really, that's the fundamental question at the heart of any initial public offering, right? Any IPO. Before a company can sell you its shares, it has to publish this mandatory confession, if you will, a document that just lays bare its entire business for everyone to see. So you can imagine, when a company the size of India's national stock exchange, the NSE, decides to go public, that document, it is so much more than a formality. It's basically a treasure map, revealing its power, its strategy, and maybe most importantly, its biggest weaknesses.
And that's what we're digging into today. This one specific filing from December 28, 2016. It laid everything out there, the company's strengths, its game plan for the future, and yep, even its biggest fears. It's really a masterclass in corporate transparency, whether they wanted it to be or not. Okay, let's get into it.
All right, first up, a titan goes public. We need to get our heads around the document at the center of this story, because this thing is not some glossy marketing brochure. No way. It's a legally binding prospectus with a really specific name and an even more specific purpose. It's called a Draft Red Herring Prospectus, or DRHP. You know that funny name, red herring? It actually comes from this big red disclaimer they have to print right on the cover, basically warning everyone that the info inside is still preliminary. But don't let that fool you. The contents? They are anything but vague. Think of it like a company's entire autobiography, put out there for the whole world to pick apart.
And this DRHP, it's the absolute first step in a very long, very heavily regulated journey. You file the DRHP, you do these road shows to get big investors excited, you figure out the price, and then you finally list. The whole process, the whole IPO is built on this one document. It's all about making sure that everyone, from a giant hedge fund to you and me, has access to the exact same information.
So let's look at the engine of the exchange. What did the NSE's, let's call it a medical report, what did it actually show about its health and power back in 2016? Let's check out the vital signs straight from their own filing.
And whoa, the numbers are just staggering. I mean, look at this. The prospectus confirms that the NSE wasn't just a market leader, it was practically the entire market. We're talking 94% market share in equity derivatives, 94%, and almost 80% in interest rate derivatives. This is a classic near monopoly on some of the most profitable parts of the financial world. Now, this is where it gets really interesting. This chart shows how the NSE actually made its money. Sure, transaction fees were the biggest slice of the pie at 56%, but look at the rest of it. A massive 30% came from investments and other income. Plus, you've got solid chunks from IT services and selling market data. This shows the NSE wasn't just a trading platform. It was an investment house and a tech company, all rolled into one powerful package.
So it's no surprise that when they listed their strengths, the list was pretty impressive. They were a leader across the board, they were vertically integrated, which is just a fancy way of saying they controlled everything from the trade to the settlement, and of course they had a world-famous brand with indices like the NIFTY 50. I mean, it paints a picture of this impenetrable financial fortress, right? But every fortress has a crack in the wall.
Which brings us to the bombshells. You see, every single one of these IPO documents has a section that lawyers and executives absolutely sweat over. It's called risk factors. And this is where a company is legally required to confess everything. And I mean everything that could possibly go wrong. For the NSC, well, this section was pure dynamite.
And here's the first one. The filing had to come clean about a massive regulatory investigation into its co-location facility. Now, this was a premium service, right, where brokers could pay to put their computer servers literally right next to the exchange's own servers. Why? To get a tiny millisecond speed advantage. And in high-frequency trading, a millisecond is an eternity.
And this quote, this is the smoking gun. Right in their own words. Tucked away on page 22, the NSE admits that an independent review found indications of potential preferential treatment to a few stockbrokers. Basically, the system wasn't fair. The exchange, the one place that has to be a level playing field for everyone, was caught giving an unfair advantage to a chosen few. In the world of finance, that is a cardinal sin.
So what happened? Well, the consequences were swift and serious. The regulator, SEBI,
stepped in and ordered the NSE to take all the money it made from this co-location business and dump it into a separate frozen bank account. Think about that. A key high-growth source of revenue was just gone, blocked indefinitely. And that's a pretty scary thing to have to tell potential investors, right?
And if a huge regulatory scandal wasn't bad enough, things were also a mess at the very top. Just look at this timeline. Less than a month, 26 days before filing this all-important IPO document, the CEO and managing director suddenly resigns. Poof, gone. This created a massive leadership vacuum at the absolute worst possible time.
Okay, so despite all of these incredible headwinds, an IPO filing can't just be a history lesson or a list of problems. It has to sell a dream. It has to lay out a blueprint for tomorrow.
And here was the game plan. Essentially, the NSE strategy was to double down on what made it so powerful in the first place. They planned to diversify their products even more, use their tech advantage to explore cutting-edge stuff like blockchain, and really push hard on attracting foreign investors and building global partnerships. This was their story of, hey, we're still strong, and here's how we're going to get even stronger.
And to really hammer home that growth potential, the document laid out this killer comparison. Look, in 2015, India's market cap to GDP ratio was just 73%, while the US was at 140%. And this turnover velocity, which is basically just how fast money is changing hands in the market, was 5 times lower in India. The message to investors couldn't be clearer. Yeah, we have some problems right now, but the potential for growth in India is absolutely massive, and we are the engine that will capture it.
You know, this one simple sentence from the prospectus really captures the entire soul of an IPO. This being the first public issue of our company, there has been no formal market for the equity shares. It's that exact moment. The moment a company goes from being private, where its value is theoretical, to being public, where it faces the judgment of millions of investors every single day. It truly is a story of a company standing at a crossroads.
So in the end, a prospectus like this reveals a company's greatest strength, but also its deepest fears. What does that tell you about the price of trust? It's this fascinating balancing act, isn't it? The company gets to show off its crown jewels, but it's also legally forced to air all its dirty laundry. It's a mandatory exercise in radical transparency, designed to lay out the good, the bad, and the ugly, so that you, the potential investor, can decide just how much that trust is really worth.